Okay, hello everybody. My name is Steve Austin. I am the financial advisor for the Town and Country 401k plan. My role is to not only provide guidance and communications, with Amy and the company, as far as kind of helping with plan design and monitoring the investments, but I am also here as a dedicated resource for each of you. You will see in a minute, there's a link to schedule a one-on-one meeting with me. So I'm available to you guys for questions about this 401k or really any other financial matters that you guys might want to learn more about. If you have questions about other investment accounts, saving for retirement or planning, for college expenses, buying a home, life insurance, really anything financially related, I'm here as a resource to you guys throughout the year. Anytime you want, you can use the link that we're going to show you in a second, and get on my calendar. Hopefully, I'll get to talk to you guys one-on-one here. Today, we're going to go through a little bit of an update on what's currently going on in kind of the markets and the economy and kind of what to expect the remainder of this year. We're going to talk just generically a little bit about investing in a 401k and why it's important for your future and retirement. And then I'm going to make sure we go over all the specific details about your plan. So jumping into kind of markets and economy, we've seen a pretty strong recovery in the economy. Unemployment numbers are starting to trend down again, which is a good thing. As the vaccine continues to get distributed and more Americans are getting vaccinated, we should start to see states starting to reopen. I know some states are wide open, other states are still pretty locked down, like us here in California. I know, it really is hard for people to kind of understand what's going on in the economy right now. When the stock market has done pretty well over the last year, since about April of last year, stock market, it took a big drop of about 35-40% in March, and then by the end of the summer it had pretty much fully recovered, and we had a pretty strong performance year last year anyway. So for those of you who already have balances in the 401k, you probably saw pretty good returns in your 401k last year. With that being said, there's still a lot of uncertainty in the economy and the markets right now. The two big ones, economically, since the market tends to follow the economy. Economically, we don't know how much damage has been done to small and mid-sized businesses. As all of the different states and regions start to open back up, we'll start to be able to assess how many of those small and mid-sized businesses, which tend to be the lifeblood of our economy, we'll start to find out how many of them are not going to return and not be able to come back to business because of COVID. So once we start to see that data, that might have some impacts on the market as a whole. From a market perspective, though, there's not a lot of issues right now. Yes, stocks are kind of hovering around all-time highs. We had a little bit of a pullback last week into this week. You're probably going to continue to see a fair amount of volatility throughout the year. But in general, all the indicators show that we're probably going to have a pretty decent positive year in the markets this year as well. As we get towards the end of this year, into November and December and into January and February of next year, we're expected to get the current administration's tax reform proposal pushed through Congress. That may have a pretty negative impact on the markets if there is a big corporate tax reform. Personal tax reform isn't going to have a huge impact one way or the other, but if they do significantly increase the corporate tax rates back to where they were before the prior administration, then there's a pretty good chance that we're going to see a pretty big pullback for about 6 months while companies have to adjust all their earnings. So that risk is probably going to start to see its way into the market late this year, early next year. But those are the two main things that I think you got to watch for and be careful of with your investments as a whole. Again, for those of you who are fairly young and you have a long time horizon to go, if you've got 10, 20, 30 years until retirement, you're not going to really worry about much of the day to day. But those of you who have built up a substantial savings already, you want to be a little more defensive. You want to be a little more cautious about what you're doing in the markets, just so that you don't see a big loss in your account. The closer you get to retirement, the more you need to really dial in what you're doing and watch how much risk you're taking in the market. And if you don't have somebody who's licensed to kind of talk to you about that, again, feel free to use me as a resource and a sounding board. So moving on from the market side, and we will be opening it up for questions at the end. So, Amy would just like to hold all questions to the end. So if anybody is, thinking of questions about market or economy or anything like that, please just hold them to the end, and I'm happy to address them. Moving on to, saving for retirement. Saving for retirement is a very important thing that everybody needs to do. The general idea of saving for retirement is that one day you want to have the choice of whether or not to go to work. And to do that, you need to build up a large enough nest egg that you can produce an income off of that savings that will sustain your lifestyle. Whatever, some people have more extravagant lifestyles, some people are very frugal. Whatever your personal lifestyle is, you need to figure out how much money it's going to take you to accommodate that lifestyle so that you know when you can quit working, if you choose to. Some people work well beyond that age when they have enough money. That's everybody's, kind of personal choice. But if you don't know how to calculate that or figure that out, we have some great calculators. The My Plan Hub website here that you guys have access to. I know Amy sent out the link to this. What this is think of this as your gateway to 401k. You don't have to have a login to get to this site. Everybody can just pull up the link on their phone or computer. You have a very good retirement calculator right here from Voya. This will help you really kind of dial in, what you should be doing for retirement. So I would encourage you guys, if you haven't done that, to take a minute and do that at some point. If you want to log into Voya, you just click on this Access My Account, and then you'll put in your login credentials. Down below here, you'll see you have all of the kind of plan documentation. It shows all the features of the plan, etc. We have a quick link to the Voya enrollment, which you'll need these two numbers below it to access. So if you're new to the plan and want to get enrolled, you simply click on this link. It's going to ask you for this plan number and this plan verification number, and I believe the last four of your social and maybe your date of birth. And then it'll allow you to go in and create your account and get enrolled. Down below, there's some videos that are just kind of 401k, primers to really just give you the basic idea of a 401k. Then you'll see my contact information, again, for any investment, financial kind of questions. You can give me a call. If you have any account questions or you're having trouble logging in or need help taking a loan or a distribution, you're going to go ahead and call this 800 number and chat with Voya. But scrolling back up here, I want to switch gears into kind of some general 401k training. So let me just switch over to the slide deck here. And Amy, can you confirm that you're now seeing the PDF slide deck? Welcome to Town and Country Linen 401k.
Yes, I can. Just
okay, great.
You can make it a little bit bigger, probably.
Okay,
yeah, that's fine.
All right, good. So when it comes to a 401k, a 401k is really, think of it like a savings account that's attached directly to your paycheck. So rather than you having to go out and save on your own, you're automatically having the money deducted from your paycheck. For those of you who follow Susie Orman, her famous quote is "Pay yourself first," right? That's what you're doing with a 401k, is you're paying yourself first before you get a chance to go spend the money. Town and Country does provide a match. We're going to go over that in a couple of minutes here. For some of you, you may also, in addition to the match, depending on your household income, There are savers credits, which have been recently enhanced by some of the new legislation. So for those of you, depending on what your household income is, you may also get tax credits for participating in the 401k, which that all just kind of happens automatically on your tax return when you file your taxes. But it can be, I think, up to $2,000 a year in tax credits that the IRS will give you just for participating in the plan. And it's a percentage of how much you contribute. So you can get up to 50% of whatever you contribute up to that maximum tax credit. A famous quote that, we tend to use a lot in this industry: the best time to plant a tree is 20 years ago. The second best time is today. So regardless of how old you are, it's important that everyone starts saving and putting away a small piece of their paycheck every day. Here's 3 different examples of what investing early does. Oh, I didn't mean to skip that one. So Katie starts at age 21, and then she stops at age 35. She puts in basically $57 and change a week for 14 years. She grows her money at the national average of 7%. Her total investment is $42,000. And at age 67, she's going to retire with about $610,000. Okay. And that's obviously, just putting in a small piece of her weekly paycheck. Mike, on the other hand, waits till he's age 35 to get started. And then he's going to invest that money from age 35 until he reaches age 67. He's going to keep contributing. And every year he gets the same growth rate of 7%. So now he's contributed almost double what Katie did, more than double actually. Okay. And at age 67, he's got about half as much money. Okay. So that's the value of time that you're seeing right there. The earlier you start doing this, the better. But obviously having $342,000 is still better than not having anything. Okay. So Anna started at age 21 and she contributes until age 67. She doesn't stop at age 35 like Katie did. All things being the same, she contributes $138,000 over that 46-year period. And now when she retires at age 67, she's going to have almost $1 million. Okay. So that's the value of starting early if you can. I know there's a lot of young people in the company and on the call. So that's something I strongly encourage all of you to consider doing. How much should you save? Well, the studies by Fidelity and the government and Vanguard and everybody else, they've all come up with a number of somewhere between 8 and 12% is what most people need to contribute each year to be on track for retirement. And if you do that for a 20 to 30 year period, generally speaking, you're going to be able to retire pretty comfortably. So I always tell people you want to do as much as you possibly can. And I apologize here. This has the 2019 data. We got to update that. The current limit this year is $19,500 for anybody under the age of 50. And it's $26,000 for anybody who's turning 50 or older this year. But when it comes to contributions and it comes to the 401k, there's really 3 decisions you have. Am I going to participate? Yes or no? If I am, how much can I afford to contribute? Now, the great thing about your plan is it allows you to change your contributions as often as you'd like, every pay period if you really truly wanted to. So if something comes up and you need to, reduce it or stop it for a couple of weeks or a month or a couple of months, whatever the case may be, you have the ability to do that anytime you need to. So you're never locked in or, when you enroll in the 401k, you're not committing to that for the entire year, which is something that a lot of people don't realize. So you decide how much I can contribute. Then you got to decide, do I want to do it pre-tax or do I want to do Roth? So to explain pre-tax and Roth, I'm going to take an example of somebody making $1,000 a pay period. If they put in 10% into the 401k, that means they're investing $100 each pay period. 10% of 1,000 is 100. Now, if that person puts that money in pre-tax, that $100 is going to go in before they calculate your taxes. So your net take-home pay is only going to go down by about $70, give or take a few dollars. However, if you chose the Roth option, your take-home pay would go down by exactly $100. Okay. Now you might ask, well, why would anybody do the Roth? And the answer is that when I invest in Roth, all the growth or compound interest that you're going to earn over your lifetime is tax-free. So to show you what that looks like, let's take somebody who's age 40 and they're going to start pulling income out of their 401k at age 70. So they've got 30 years to invest the money. And let's just imagine they have $10,000 today. And if they're an average investor getting that same return of 7% that we were showing you on the previous slide, that means their money's going to double roughly every 10 years. So if I've got 30 years, that means my money can double 3 times. So 10 is going to double to 20, 20 is going to double to 40, 40 is going to double to 80. So if I had chosen pre-tax, I would owe taxes on the full $80,000. However, if I had selected Roth, I would have paid taxes on the $10,000 that I put in, and I would now get the whole $80,000 tax-free. So there is no right or wrong. It's really, the younger you are, the more attractive Roth is going to be for you. But if anybody has questions about their personal situation, again, you can schedule a one-on-one call with me and we can kind of go through that to help you understand it. So now we decided how much we're going to contribute. We decided pre-tax or Roth. The last decision, the third decision you have to make is how do you want to invest your money? And inside of a 401k, you have a whole bunch of different investment options. Some of you may be fairly savvy investors and know what you're doing and comfortable with it, and that's great. If you have questions, you can always call me and get help. And many of you are going to pick what is called the default option, which I like to call autopilot for your 401k. That's an age-based fund. And the way that works is Voya, if you select to do it for me when you're registering, they will put you into that age-appropriate fund. And what that fund does is the closer you are to retirement, the more conservative they will manage the money. The further away you are from retirement, the more aggressive they will be. And as you get older throughout the years, it will get gradually more and more conservative. But those funds are a way to let the professional money managers invest your money for you so you don't have to think about it or worry about it or track it or follow it. So about 75% of all 401k participants use those target date or age-based funds. Generally speaking, as an investing kind of 101, you want to have a balanced approach. You want to have a portfolio that covers a bunch of different categories, and ultimately it will help you to maximize your own personal retirement growth. Everybody's different. Some people are very conservative. They don't ever want to see their account lose money. And there's options for you in the plan that are perfectly safe and will never lose anything. And then some people are very aggressive and they want to swing for the fences, and that's okay too. There's no right or wrong way to invest. It's really just understanding what's right for you. And that's something we can definitely help you do. Getting to the specific details about the Town and Country plan, anybody who's with the company for 6 months, at least 21 years of age, is eligible. You are permitted to take a loan from the plan. The IRS allows you to borrow up to 50% of your account balance. The minimum loan is $1,000. The maximum loan is $50,000. Loans are for any reason. You don't have to tell anybody what you're doing with the money. It's just your money. You pay yourself back all the interest. So it's better than having to go put something on a credit card. But, I encourage people not to use it frivolously. This isn't meant as your vacation slush fund. This is meant for retirement. So, if you have an emergency and you need to do it, that's what it's there for. But, this isn't really meant to be able to go, to Riviera Maya for a week or something like that. Although I've had people do it. Again, the plan allows you to do both pre-tax and Roth. And now let's get to the best part. You guys have a very generous company match. The way the match works is Town & Country will match you 100% of your contribution up to 3% of salary. So if you put in 1%, they match you 1%. If you put in 2%, they match you 2. If you put in 3, they match you 3. Then they match 50 cents on the dollar for the next 2. So what that means is if you put in 4, they match 3.5. And if you put in 5 or more, you'll get a 4% match. Now, that's not a formula that the company necessarily came up with. That's an IRS formula that's pre-approved. And what that does is that gets you, if you put in 5%, they put in 4%, that gets you right to that 9%, which is the bottom end of that 8 to 12 range that we were talking about that most people need to be successful for retirement. So again, do as much as you you can afford to do, but at a minimum, you want to try and target 5 to maximize the company match. Now, with that said, the minimum you're allowed to contribute is 1% of salary. The maximum is 100% of your payroll, up to the annual limit that I mentioned earlier. The match will be deposited to your account quarterly. Your contributions get deposited every pay period. The match is also immediately vested, so that means that whenever you do leave the company, that you will take all of that money with you. As you see here, we have some of these enrollment materials. So there's this quick enrollment guide. We just went through the 401k education. There's some other educational videos and plan highlight documents here for the plan. For anybody that needs a beneficiary form, you can go here and download it right here on this website. You can see this beneficiary designation form. Just click on that and then fill that out. Voya does not keep that on file. That's something that you keep with your important documents. If you have a will or a trust, you keep it there. And I do always recommend that you give a copy to your actual beneficiary so that they have it on file. At this point, I want to go ahead and open it up for questions. For any of you that want to get on my calendar, go ahead and use this link to schedule a 20-minute planning session. If we do need more time, depending on my schedule, I may be able to accommodate you right there. But generally speaking, most questions and comments we can kind of handle in about 20 minutes. But if you need more time, we can always schedule a follow-up session. Again, you can schedule with me as often as you like throughout the year. Amy, I don't know if everybody's unmuted yet, but if you'd like to go ahead and unmute everybody, and I'll stick around for a few minutes for questions. If you do not have any questions, obviously feel free to go ahead and sign off. It was great to virtually meet everybody. I look forward to talking to hopefully all of you guys in the future, and have a great rest of your day.
Steve, I have Puneet. He would like to ask you a question.
Sure, go ahead, Puneet.
Hi, Steve. Thanks for taking the call. Quick question. So you mentioned the IRS limit. I believe there's 16 or what is the limit?
The limit is 19,500 if you're 50, under age 50. But if you're 50 or older this year, it's actually 26,000 this year.
Okay. So taking that scenario, let's say 19,000. And if you break it down based on your salary and payroll cycle, and let's say if you max to 19,000 of your contribution, and or if you go over, what happens then? And does that also count what's company matches? So it becomes, let's say, they took 5% of the 19,000 or whatever, so it becomes 23,000.
Yeah, so the 19.5 is only your contributions. Company contributions can exceed that. So you don't have to worry. You're always going to get your money, even if you put away your maximum. You're always going to get that additional 5% match, or I'm sorry, 4% matching. Your other question was, can you go over? And the answer to that is no. The payroll company you guys use, Paylocity, they have the limits hard coded into the system, so that whatever pay period for the year you reach the limit, it's going to automatically stop contributing. Now, that's really important because if you max out the plan before the last payroll of the year, you're not going to get matching. So you want to time your contributions to max out the last pay period of the year if that's what you're doing.
Cool. Thank you. That was my question.
Okay.
Steve, I have Rajesh.
Hey, Steve, I have a question about interest. Like, if I take a Roth IRA, I will be paying interest now versus paying interest at the age of 67, right? So is there a less interest after age 67, or it would be whatever interest rate at that time?
Yeah, so that's that's kind of the crystal ball question, right? I mean, if we had a crystal ball to tell us what tax rates were going to be in 20 or 30, and I don't know how old you are, Rajesh, but you sound like you're probably in your 30s or 40s. So, I mean, for you to know what tax rates are going to be in 20, 30, 40 years, there's no way of knowing. There's a couple of things we can look at. I mean, number one, the first thing you got to ask yourself is, what's my lifestyle going to be? If you're going to live a pretty inexpensive lifestyle and pool a very minimal amount of income at retirement, then you may very well be in the lowest possible tax bracket in retirement, and that may be a slightly lower bracket than what you're in today. But what I would pretty much tell anybody is, if you look at all of the trillions of dollars that were just spent on stimulus for COVID, you're going to see about $2 trillion spent in the next few years on infrastructure, which is rebuilding bridges and airports and tunnels and roads. And then Social Security and Medicare spending, along with the current national deficit, which, if you look at the statistics, the current U.S. debt, the cost of the interest payments alone. So for anybody who ever has had a credit card and ever made the minimum required payment on a credit card, you know that you're going to be paying that credit card off pretty much for the rest of your life. And that's kind of where the U.S. is at, with our total national debt hovering around, I think it's the last time I looked, about 19 trillion. The interest alone in a couple of years will be more than what we spend on our entire defense budget, plus Social Security and Medicare. So in essence, right now, the U.S. is spending about $1.35 for every dollar it receives in revenue. So that's not a sustainable model under the current tax code, which is why taxes have to go up at some point in the near future. Right. How long and how high, we have no way of knowing. But I would be willing to take a bet that for just about everybody on the phone, by the time you guys get to retirement, taxes are going to likely be pretty significantly higher than they are today. Now, the other part of that question, Rajesh, is regardless of what your tax rate is, if you used my example, do I want to pay taxes on the $10,000 or the $80,000?
Right.
Well, even if I'm in a 30% bracket today on $10,000, I'm only going to pay $3,000 in tax.
Right. Yeah.
And let's say somehow you were in the lowest bracket in retirement of 15%, and you do 15% of 80,000. Off the top of my head, that's
12,000.
12,000. Yeah, thank you. $12,000. So that's like 4 times what you would pay today, even if the tax rates were reduced in half at retirement.
Got it. And that's a very good explanation. But that brings, like, my second question is, right now I may be paying pre-tax to my 401k. Can I change that to Roth?
Good question. So you can change what you're doing for going forward. You
Okay.
cannot go back and convert all the old money until you leave the company. And at that point, you would have an option of rolling it over to an IRA and doing what's called a Roth conversion, where
Oh.
you'll recognize, say you rolled over $100,000, you could take that income of $100,000 and spread it out over 2 years, but you'd have to pay the taxes on it out of your pocket.
Okay. Understood. Thank you. Thank you for the
Well,
nice explanation.
and there is no right or wrong, and you can split your contributions. So believe me, I have people that say, hey, I want to do 5% pre-tax and 5% Roth.
Got it.
But the company money, the matching dollars are always pre-tax in nature. You'll always pay taxes on that portion at your retirement.
Got it.
Okay, do we have any other questions?
Nobody else has raised a hand, but please, you're welcome to ask, or you are welcome to make an appointment with Steve. Anybody else? Don't be afraid. That's why Steve is here.
Steve, just so I'm sure, this is Julie. How are you? Hope all is well.
Julie?
Just to reach you, just so I'm clear, it's the info@consultwithapex.com to reach you?
Yep, that is my direct email, even though it says info or Steve at Consult with Apex. Either one comes directly to me.
Excellent. All right. I will reach out. But thank you.
Yeah, sounds good.
Terrific. Thanks a bunch.
Mm-hmm. Anybody else?
I think we're good.
Okay, Amy. Well, we'll do it again tomorrow. And thanks, everybody. And I hope to talk to you all in the near future.
Thank
Thank
you.
you.
Thank you.
Thank you for participating.
Thank you. Bye.
Bye.